Welcome back to another video dealing with Introduction to Financial Accounting. In this video, we're going to continue to talk about merchandising operations. Specifically, we're going to look at the seller side of transactions. So after you complete this video, you should be able to define sales returns, define sales allowances, define sales discounts, and finally, you should be able to prepare proper journal entries for the sale of merchandise that involve sales returns, allowances, and discounts. So when we look at returns, allowances, and discounts for a seller, just like we did for the purchaser side, we need to do the same thing for the seller side. We need to define each of these terms. So what exactly is a sales return? Well, sales return is when the seller accepts unsatisfactory merchandise back from a previous sale and offers credit to that buyer. This is the opposite side of the purchaser's return that we looked at in a previous video. In a previous video, we also looked at the purchaser's allowances. So what exactly is a sales allowance? Well, it's the other side of the same coin. Sales allowance are the reduction in selling price to entice a buyer to keep unsatisfactory merchandise. So we sold somebody, a store, a retailer, some merchandise. For whatever reason, that merchandise isn't acceptable to the buyer, to the purchaser. This purchaser wants to return it to us. Maybe it's the wrong color, wrong size, whatever, okay? Doesn't matter. They want to return it to us. We really don't want to accept the return for whatever reason. Maybe it's merchandise that we can't sell to somebody else. Maybe it's outdated merchandise, whatever the reason is. So we as the seller want to entice the buyer to keep it. So we ask the buyer, hey, if I reduce the sales price of this inventory or this merchandise that you do not like, would you keep it? And hopefully the purchaser says, sure, I'll keep it. That's what a sales allowance is. Sales discounts, well, this is the opposite side of the purchase discount, right? We looked at purchase discount from a buyer's perspective. Now we're going to look at that same discount, but this time we're going to look at it from the seller perspective. So sales discounts is the cash discount that we offer, meaning the seller offers that to entice the buyer to pay that invoice within the discount period. So just as the buyer receives that purchase discount, which is enticing that buyer to pay back that purchase invoice sooner, this is the other side of that transaction. Here's what the seller does. The seller offers not a purchase discount, but a sales discount. And it's the same thing, 210 net 30 or 315 net 60, whatever the terms are. The point is, the sales discount and the purchase discount, it's the same thing. We're just looking at it from two different perspectives. Okay, so what happens to a seller what journal entries does a seller make whenever they book a sale, right? They sell inventory. So we're going to look at the same exact transactions that we looked at for the purchaser. We're just going to look at them now from the seller side. So previously we looked at Charlie Brown Incorporated or Charlie Brown Corporation, and we said we were Charlie Brown. Now we're going to look at the opposite side and say, okay, now we're Woodstock Incorporated. Okay, what journal entries do we need to make? So let's assume that Woodstock Incorporated sold Charlie Brown $50,000 worth of merchandise. That merchandise had a cost to us as Woodstock of $30,000. Okay? The terms of the sale are 210 net 30 FOB shipping point. They tell us that the shipping cost was $1,000. Now, First thing we need to recognize, A, we are the seller. FOB shipping point, who pays the shipping cost? The buyer. So we have no journal entry for that shipping portion, okay? Whenever we book a sell, we always have to book 2 journal entries, okay? This is very important, and I definitely put this in your notes. When a seller books a sale, we have 2 journal entries. The first journal entry is to recognize the sales revenue. The second journal entry is to recognize the cost. And I just realized that there was an error here. The cost is $30,000, not $50,000. Okay, so first thing we're going to do as Woodstock Incorporated is we're going to book the sale. We're going to debit accounts receivable. Why accounts receivable? Well, because we're offering credit terms, right? We gave merchandise to Charlie Brown with the promise of Charlie Brown to pay us. So we have a right to receive cash or payment, okay? So that's why we're debiting accounts receivable, crediting sales. That recognizes the sales portion. The second journal entry is to recognize the cost of that inventory. Well, how much did that inventory cost Woodstock? Again, we're Woodstock. It cost us $30,000. So we had to buy this merchandise from maybe a from a manufacturer, okay? That manufacturer sold us that merchandise for $30,000. We then are going to turn around and resell it to Charlie Brown company, obviously for more money, right? Because we need to make a profit. So to book the cost of the transaction, we debit cost of goods sold, which is an expense account, and we credit inventory. That makes sense. Why does it make sense? Because we are selling inventory. Our inventory is decreasing, so we have to credit inventory. That asset is being sold, right? We don't have that asset anymore. It's being, for lack of a better term, used up, or it's expiring because we're getting rid of that inventory or we're getting rid of that asset. We need to recognize that expense. That's why we debit cost of goods sold. Again, we will not do the journal entry for the shipping cost. Why? Because it's FOB shipping. But what if it were FOB destination? FOB destination says that the seller, us, Woodstock Incorporated, has to pay the shipping costs. In that case, we would debit freight out or shipping expense, and we would credit cash. We do not have that journal entry here. Why? Because it's FOB shipping. Okay. So the next thing we need to look at is what happens if we have a sales return. Okay. Basically, hopefully we remember from our last video, Charlie Brown got 30 grand worth of merchandise that was damaged. He said, I don't want it. Woodstock Incorporated, take it back. Give me a credit. So, since Charlie Brown Incorporated discovered that 3 grand of the merchandise ordered was damaged, we know that the cost of that merchandise to us was $12,000. So, Charlie contacted us at Woodstock Incorporated, and he wanted to return the merchandise for a credit. We said, no problem. We'll take care of that for you. What journal entry do we need to do? Well, previously we recognized that we had a receivable and we recognized that we had sales. Some of those sales and some of that receivable isn't owed to us anymore. We don't have that sales anymore. We don't have that receivable anymore. Why? Because there was a return. So what do we do in that case? Well, we have to debit sales returns account. The sales returns account is a contra revenue account, okay? It's just like the accumulated depreciation. We looked at accumulated depreciation as a contra revenue or contra asset account. Sales returns is a contra revenue account. It goes against the revenue, right? We would never book sales, okay? Meaning, If we had a return, we would never hit our sales account. Why? Well, because sales returns is an important number, and we're going to see coming up that we're going to have to calculate things like gross profit, gross profit ratio, and things like that. So we need to keep our gross sales intact. In order to keep our gross sales intact, we have these two contra revenue accounts, which we just saw one right here, sales returns, and we're going to see the other one a little later, sales discounts. Okay. So how do we handle this journal entry? Well, again, we need to decrease our sales, decrease our receivables. Accounts receivable is an asset. How do we decrease an asset? With a debit. So we're going to debit accounts receivable for $3,000, and we're going to credit sales returns, which is that contra revenue account, for $3,000. Now, we are receiving inventory back, right? Even though it's damaged, we're still willing to accept it, right? That means that we're going to take that damaged inventory and we're technically going to put it back in inventory, okay? So we don't have, or we have less expense here, right? Previously, we recognized $30,000 of cost of goods sold. Well, of that sell, some of that cost came back to us. So we need to back out that cost and put that inventory, or put that amount back into inventory. How do we do that? We debit inventory for $1,200, which is the cost of the merchandise. We credit cost of goods sold. I want to flip back for a second. This is what we did for the sale. When we have a return, we just do the exact opposite, right? We do the exact opposite. The only catch is that we don't debit sales, we debit sales returns, okay? So here we have an example, and again, it should be familiar to you. In addition to that damaged merchandise, right, Charlie Brown Incorporated discovered that $1,000 of that merchandise was the wrong color, right? I think we said we wanted ruby red, and they sent us hunter green, right? So Charlie Brown Incorporated contacts us at Woodstock. They say, hey, you sent us the wrong color, right? We don't want it. Well, we at Woodstock, we're savvy. And we say, hey, you know what, Charlie? Would you be willing to keep that merchandise if we gave you an allowance, meaning we gave you a reduction in the price to keep that merchandise? Charlie Brown says, yeah, sure, why not? It's hunter green. My clients really don't like that, or my customers don't like that, but I imagine I could probably sell it. So we offer Charlie Brown Incorporated a sales allowance. This is the second contra revenue account, okay? So in order to recognize the fact that Charlie Brown owes us $500 less, why 500? Because we're giving him a 50% discount on that merchandise that was $1,000, okay? We need to decrease the revenue by 500. How do we do that? Well, accounts receivable is an asset. We decrease that asset with a credit. Then we need to decrease our sales. But remember, we always keep our sales figure intact. We use these contra revenue accounts to offset that gross amount. So instead of debiting sales returns, we're going to debit sales allowances. Okay? Sales allowances is the account we use whenever somebody wants a return, but we convince them to keep that merchandise at a discounted price. We use sales allowance. Okay? So right here, we get to the end of the returns and allowances and all that. And because keep in mind, we still have credit terms, 210 net 30. Okay? So we need to get paid at Woodstock Incorporated. How much are we going to get paid? Well, we need to look at the accounts receivable account for Charlie Brown. And we need to say, okay, Charlie originally bought $50,000 worth of merchandise, and the sales invoice that's the paperwork that we hold. The sales invoice is the other end, or the other side of the coin when we're looking at the purchase invoice, right? It has the same information. The sales invoice is just what the seller keeps to recognize how much was sold, the credit terms, all that other stuff, okay? So we look at accounts receivable and we see that, okay, based on our sales invoice, we initially sold them $50,000 worth of merchandise. $3,000 of that merchandise was returned to us. Why? Because it was damaged. So we used the return account, sales return account. He had an issue with the wrong color, but we persuaded him to keep that at a discount. So we discounted the price $500. That's our sales allowances. Charlie Brown now owes us $46,500. Okay, so let's get paid. Well, first thing we need to recognize really is Charlie Brown Incorporated paying us within the discount period? And let's assume in this example, yes, he's paying us within that 10-day discount period. How do we book the entry? Well, very easy. First thing we recognize is the fact that Charlie Brown Incorporated doesn't owe us money anymore. They are satisfying that accounts receivable, okay? So we need to get that accounts receivable off the books. How much are we getting it off the books for? Well, the amount that it's on the books for now. It's on the books now for $46,500. So we need to credit accounts receivable for $46,500. That wipes out the receivable, okay? How much cash are we getting? Well, we're not getting $46,500 because we offered credit terms. We enticed Charlie Brown Incorporated to pay us sooner than later. We gave them a 2% discount. So the cash we're receiving is actually $45,570. Cash is going up. How do we increase an asset? With a debit, we're going to debit cash. Our debits and credits don't equal at this point, right? We have $46,500 and we have credit and we have a cash debit of $45,570. What's the difference? Well, the difference is the discount, right? Which we already previously calculated as 2% of $46,500, which ends up being $930, okay? So, sales discount, this is really the third contra revenue account that we see. We want to keep track of those sales discounts that we offer, right? Or we want to keep track of those sales discounts that we offer that people are actually taking advantage of. So we have that contra revenue account, sales discounts. We debit that for $930. And that, my friends, is the seller side of the same transactions that we looked at in the previous video when we looked at the purchaser side. So your key takeaways are the journal entries we need to make. If I were you, I would go back and I would put these journal entries on a note card and memorize them. They're not going to change. If somebody pays within the discount period, we have to debit cash, debit sales discounts, credit accounts receivable. For how much? Well, we need to calculate that. We get it off the books for the amount that it is, or that we have, we get the receivables off the books for the amount that we have recorded. In this case, it's $46,500. How much cash are we going to receive? Well, we can calculate that out very easily. The difference is that sales discount, okay? If we did not have a sales discount, what would we do? Well, let's say Charlie Brown paid us within 30 days. What we would do is we would get rid of our sales discount because we don't have a sales discount to book. We would still debit cash, but in this case, we would debit it for the amount of the receivables. They are going to pay us $46,500. And this is the journal entry that we book if if a client or if a customer pays us outside of that discount period. Okay? When we come back in our next video, we're going to go ahead and look at, take a deeper look at the income statement. And we're going to see some of the ratios that are important for us to calculate specifically from the seller side. So please tune back in for that video.